Thank you for joining us today on the Quest Trust Company Self-Directed IRA Saturday. I'm going to be announcing this presentation for you and introducing our speakers. Today we have Cody Laughlin and Brian Alfaro from Blue Oak Investments here in Texas, and they've got a lot of great information to share with us today on a topic I think that is very timely, and I know we're hearing a lot of questions about. It has to do with hedging against interest rates as they are going up, and people are looking for steadier flows of income. I mean, I think we all know it's been unprecedented in terms of the rapid rate increases that we've been seeing, and there's been some ups and downs, certainly with investors everywhere, and everybody's trying to find that right place to be. So with this class, Cody and Brian, they're going to talk a lot about doing a deep dive in terms of inflation and the ramifications of that. And again, some potential ideas for how to navigate around it. And so they're going to answer a lot of questions about the types of assets you can use. Again, perhaps where higher rates can be derived. And again, just give you insights and details in terms of what your options are. So we'll have those two join us in just a moment. But first, I do want to just give you the straight up introduction to Quest and who we are and what we do. Give me 1 second here. All right. So Quest Trust Company. We are the largest self-directed IRA custodian in the state of Texas and one of the leading self-directed IRA custodians in the country. Currently, we have about 20,000 investors that are all across the country. We have over 100 employees, and about a third of them are what are called certified IRA specialists. These are people who have taken a little extra time. They've gotten extra training and credentialing in the area of IRAs. I myself will be one as of next week once I sit for the exam as well. So I'm looking forward to that additional level of service and benefit I can bring to our clients. Currently under administration, we have in excess of $2 billion. And right now, our clients are sitting on about $400 million in cash. That means our people are looking to make deals. They want to find out about investments. They are looking to direct the funds. So again, things like the networking that we offer, whatever side of the equation you're on, whether you are somebody looking to invest or someone looking for investors, pay attention to what we do here beyond just the administration, because we can help either way. Now, just as a preface to this, the purposes of our seminar today are purely that of education. At Quest, we do not offer tax, legal, or investment advice. So as you are looking for investments and you are looking to engage in some type of a transaction, always do your due diligence and run anything by your legal, tax, and or investment advisor. All right, so a self-directed IRA. Well, it really in many ways is no different than any IRA you're going to find anywhere else. IRAs are IRAs are IRAs. The term self-directed really refers to the fact that with a self-directed IRA, you get to choose the asset you invest in. Quest, we don't sell investments. We set up the IRA and you tell us where to direct the money. So like any IRA, it has tax savings. They all have that. And of course, any kind of investment can offer you diversification. The uniqueness here with the self-directed IRA is that you're the one picking the investment. You're not just going to somebody who offers X or Y. Now, as a result of that, because you're the one selecting the investment, you are investing in something you know. I've been coming across a lot of clients lately, some potential new clients. They have very specific expertise in areas around real estate. They are excited because they can now leverage that knowledge, that experience into their IRA. And again, it gets them away from the traditional types of investments like stocks, bonds, mutual funds, things of that nature. Now, the last thing I think is very unique for a self-directed IRA is something we think of as being social impact, social investing, if you will. Now, we've all heard of this. We're all familiar with the term. You know, in many cases on a larger scale, it's companies that are trying to be environmentally friendly or reduce their carbon footprint or things of that nature. And that's all great. I would never say that's unimportant. However, I would say that with a self-directed IRA, I believe personally, you have a chance to make more of an impact on a local level that is going to be felt more than those broader concepts and executed transactions with the nature of business. What I mean by that is this. You think what happens when you are going to renovate a property in a neighborhood, a rundown property. The impact you're making is that you're improving the community right there. You are taking the eyesore and you are making it something that's livable and something that's going to improve the overall neighborhood, the tax base, etc. But what goes into that? Well, of course, we have to renovate that property in this case. So we are injecting money into the economy because we are hiring local people and we are sourcing materials locally. So we are having that greater impact on our community, perhaps than any other kind of investment could. All right, so the types of IRAs you can set up here, we basically put them in 3 buckets. And again, these IRAs are all the same you could find elsewhere. There's the personal IRA, the traditional, and the Roth. The traditional also being known as the rollover, where somebody might take 401k plan assets and keep them completely deferred. There are business plans. The nice thing about these business plans is in many cases, they will allow significantly higher contributions than you could make to a personal IRA. And because they're related to the business, they provide a benefit there as well. Last, there are the specialty plans. This includes the health savings account and the education savings accounts. These allow tax-deferred investments, and they allow tax-free distributions for their various purposes, that being health expenses, education expenses. So as you want to get to know more about them, reach out to us and we will give you all the details. Now, I mentioned slightly a little bit before where Quest offers additional opportunities. One is live networking events, which we are resuming here in Texas. These are what we call our self-directed IRA socials. They are held every first, second, and third Tuesdays of the month. First Houston, second Austin, and then third in Dallas. Separate content is always provided for each of them, but the themes there are that there is going to be education, networking opportunities, and we will supply food and drink. So it's a very relaxed atmosphere. It's a place where you can learn more about investment concepts. And it is also a place where, again, you can work with other people, again, those who might be offering deals, or if you have a deal to offer, perhaps find investors. Also, we have our full range of web-based classes that are also going on. Things like our session today. We have a weekly class on Tuesday as well. We are still also doing our nationwide virtual happy hour. That's on the 4th Wednesday of every month. That was something we started in the COVID period, but we've kept it on because it was so popular. So again, a nice way to just, in a very relaxed environment, introduce yourself and maybe find people to work with one way or the other. And of course, everything we do is going to be archived on our Facebook page and our YouTube channels. So if you miss something, you always have the chance to find it again. And that does include the socials as well. Okay, Quest Expo, it's coming up. We're very excited about it. We've been seeing the lineup of speakers as it's been getting very long. It is going to be 3 days of some hypercharged networking, great panels, great discussion groups, professionals of all sorts in the alternative asset and real estate field. So this is one of the biggest real estate conferences you're likely to find. So please check out the website. It's questexpo.com. Now, we are still actually at a point where you can get a discount on your ticket. And if you use that code that's in there right there, that's my last name, Sabaji30, you can also still get an additional discount off of the early bird pricing as well. So I hope you'll reach out, and I hope we'll see you there. Because again, that event is going to prove to be something, I think, really special this year. It's something that's gotten bigger and bigger. Again, the panelists that I'm seeing and the speakers are among the best that we know and that have, again, are accomplished in the real estate field. So I think it's going to be a really great one. And we did just hear, you football fans, Emmitt Smith is going to be there as well doing a discussion. So if you're a Cowboys fan, don't miss it. All right. I just want to wrap up quickly. If you do want to reach out to myself or any IRA specialist, by using that QR code, you can access a calendar for the IRA specialist team, set an appointment, 15, 30 minutes. We can take you through everything. You can always ask questions of us on our live chat as well. You can just call us on our 800 number or just shoot an email to us. All right. So now it's my turn to turn it over to Cody and to Brian. Again, the firm is Blue Oak Investments. They are a major investor in apartments and other types of real estate assets. Again, guys, you set the bar very high when you're telling them that you're going to help them hedge against all this insurance or interest rate risk that's out there right now. So I hope you brought your A game.
Well, Steve, it's an absolute pleasure to be back here with you guys at Quest and all the great Quest clients here. We appreciate you having us back, and we're very excited to kind of talk about and address this massive elephant that is in the room, and that's on everybody's mind, which is the rising interest rate environment. And so we are going to talk a lot today about how we are positioning ourselves within our portfolio to kind of hedge against that risk, and some considerations that we feel like your Quest clients should also be considering as well in doing the same. So, but with that, for those who don't know, Brian and I are our team. We are Blue Oak Capital. We are an independently, privately held investment group based here in Houston, and we focus on delivering alternative asset investments outside of the equities market to investors who are looking to create a portfolio of passive income to create that legacy, that generational wealth for them and their families. And we also believe in bringing investment capital into Texas and keeping investment capital here in Texas, so that way we can continue to improve our communities and grow the great potential here that's in our home state. So with that, real quick, I'd like to introduce or have Brian come on and introduce himself and his background real quick.
Yeah, absolutely. First of all, thanks to Steve for having us in the Quest Trust Company. We love giving these presentations. As Cody mentioned, my job at Blue Oak Private Equity Group is to make sure that I'm speaking to investors who want to get out of the equities market or diversify out of the equities market and invest their dollars in Texas, invest in hard assets, and find that hedge against inflation. So if you want to speak to us after, we're going to have some contact information at the end. We'd love to chat with you and find how you can, invest with us, help support Texas, help our market grow while also hedging against your inflation.
Yeah, thank you, Brian. And I am the director of acquisitions here at our team. And so I'm responsible for deal analysis, deal acquisition, and vendor relations and such. And then we have our third partner, John Beatty, who unfortunately couldn't be with us today, but John is our chief investment advisor, so to speak. So with that, let's kind of get into today's conversation. And what we want to do is we want to kind of set the context of our conversation today with kind of the Fed monetary policy and the behaviors of the Fed over the last several months. And if you draw your attention to the screen here, how many of you recall this infamous statement from the Fed last year, which inflation is transitory. And I think that is a remark that will probably be a staple on Jay Powell's career for forever, really, because I think the market at the time that the Fed was promoting this inflation as transitory, the market was in disagreement. The market was signaling or indicating that they just didn't agree with that. But, up until this point in time, at the end of last year, the Fed was taking a very accommodative position, after the pandemic recovery or during the pandemic recovery, and they rightfully should. There was a lot of unknowns and concerns about the length of time in the recovery post-pandemic, both in the labor market as well as the credit markets and such. And so the Fed responded in an appropriate way, but also had a very grim outlook on how long that recovery was going to be. And so they took a very accommodative position really up until December of 2021. And despite the market pushing back and disagreeing, the Fed consistently signaled to the market that we were not going to be raising rates until really 2024, even early 21. They were indicating as late as 2025 before we were going to see any rate hikes. And, up until that point, the Fed was maintaining its transparency and its consistency in its signals up until December. But then in December, a drastic change happened. The Fed took an unprecedented reverse course and all of a sudden began signaling rate hikes in 2022, and not just a few, but multiple rate hikes in 2022. So the question is why? What really changed? And you could see here, this is a headline from the New York Times back in from December. And as we started to see more inflation data come in, as we progressed through Q4, it was becoming more evident that maybe this inflation was not as transitory as the Fed may have believed, right? We still had supply chain disruptions that were not being resolved, and wasn't very clear that they were going to be resolved in a short term. We had consumer demand that was significantly exceeding supply output, also putting more stress on that broken supply chain infrastructure. And then we also had a accelerated labor recovery, and you saw this tightening of the labor market and unemployment going down back to almost pre-pandemic levels, which also drove up wage inflation. Again, also putting that pressure on the labor market, which is ultimately affecting consumer pricing. And so I think the Fed started to really realize that inflation expectations were starting to run away if they weren't going to have any intervention. And so I think you also could argue that there was probably some negative publicity too in the headlines with the current administration, in regards to their enactment or lack of enactment on hedging inflation. And so I think that put a lot of pressure on the Fed to really respond in a more aggressive way. And so what we saw was the Fed take a position from accommodative to a very hawkish or aggressive attack on inflation. And so what have we seen since that time in December? Well, inflation has continued to soar, right? And so you saw early in April, headline CPI hit a 40-year high at 8.4%. We saw the Fed's preferred measure of inflation, which is core PCE, which is a more broad look at inflation, and it strips out some of the items that aren't or that are included in CPI. But that inflation was 6% or higher, also another historic high. And we saw, again, the supply chain disruptions that weren't resolving yet. And there's data to support that in early January, we were starting to see the peak of some of those disruptions and maybe starting to see some recovery in there. But we still had issues around things like housing, construction materials, used vehicle inventory, food shortages as some of the biggest variables that were playing into those supply chain interruptions. And it just really, again, continued to put more and more pressure on the Fed to do something. And so, Brian, what was the Fed's response to that?
Yeah, that's a great question, Cody. What did the Fed do? Which I think we all know what the Fed did at this point, halfway through the year. the Fed's response was to raise rates aggressively to try to curb this inflation. They've made it very clear that their number one priority is to just smash this inflation. So the Fed started signaling as many as 8 rate hikes in March of 2022. We've heard various numbers. Some said 6, some said 8. We've seen some people, some banks that did some surveys that said as many as 12, but they were clearly signaling that they were going to raise interest rates. So on this chart here, you'll see the Fed fund rate. And the Fed fund rate is basically the rate in which commercial banks use to borrow and lend their reserves to each other. It's what they're charging each other if one is short and one is over. So when the FOMC raised the Fed fund rates, spreads for borrows increased. So that means that we started paying higher interest rates. This chart, which is only showing the last, call it year and a half, actually less than a year, you'll see that it drastically rises up, but this rate historically has been as high as 20% in the 1980s when there was runaway inflation back then. And then it also was as low as 0%, which we saw actually during the pandemic. On the next slide, you'll see a little bit more detail about another number that we like to keep an eye on, which is the 2-year treasury. The 2-year treasury saw the steepest increase in the shortest amount of time on record, which was about a 30% increase, which is just insane. So to us, what that means is if you're a short-term borrower or a variable rate borrower, this is painful as rates have drastically increased in very short order in Q1. So this chart is something that we keep a very close eye on as somebody who may be using floating rate debt on potentially some of our loan products and some of our assets. This is a number we keep a close eye on, along with the 10-year treasury, which we'll see on the next chart. So in addition, the 10-year treasury has also experienced a dramatic upward movement from 150 basis points to near 300 basis points as of close of business on Friday. If you look up the 10-year treasury, you'll see it was 2.94%. And the 10-year treasury is basically used to measure long-term investor sentiment. So if investor confidence is high, we're going to see falling prices and demand for the 10-year treasury as investors feel like they can achieve higher yields elsewhere. So unfortunately, the Fed doesn't have much control over the 10-year treasury because it's determined by the market and what they sort of are baking into their sentiment on where they think the market is going. So what has the 10-year treasury and the 2-year treasury done for our business? On the next slide, you'll see it has raised the cost of capital. We've seen a massive increase in the cost of capital ever since this started happening. So one thing that we've seen is the forward SOFR curve, which reflects future expectations of their monetary policy. On May 28th, 2021, which is about a year ago from today, the forward SOFR curve was actually 0.01%. And as of Friday, this past closed Friday, it was 1.14%. And forward projections of the curve have it over 2% by September and over 250 basis points by November. So what that means is rates will continue to rise and the market expects them to continue to rise. Other things that we've seen are near-term rates. They're all but guaranteed to increase, but it's also like we don't know how far the Fed is going to push. Is it going to be a June hike? Is it going to be a July hike and then a stop? Or are they going to continue to raise interest rates throughout the rest of the year? So what we're having to do as borrowers, as people that are still buying in the market, is we're now having to factor in these rising costs into our underwriting model, which is something that Cody does. And we're having to factor in rate caps, which we'll cover in a little bit more detail and talk a little bit about how expensive they've got. We've got to hedge against our risk by putting those rate caps on our debt to make sure that our interest rates don't go, as a runaway throughout the business plan. But unfortunately, the market uncertainty and volatility is spooking lenders. And that's, they're passing that fear on to us. We're having to pay more for the capital, and we're just not quite sure what the Fed is going to do. And on the next slide, Cody's going to talk a little bit about how we're hedging our risk from this rising 2-year and 10-year treasury.
Yeah, that's right, Brian. It's a big question right now is knowing that we're in this rapidly rising interest rate environment. We have inflation that is still at historic highs. How are we hedging our position when we look at our portfolio, right? And so if you look back on the transactional volume in commercial real estate over the last, call it 12 to 24 months, most of that transactional volume was executed on variable rate bridge debt. And the reason being is, we saw a hyper competitiveness from the bridge debt funds coming into the marketplace because all of a sudden they were flushed with liquidity. And so they were able to come in and compete more aggressively than what the agency debts could, which gave us better terms, gave us opportunity to kind of get more aggressive. when it came to being able to go out and pursue new acquisitions. So the unfortunate thing is with variable rate debt, your interest payments are subjective to your interest rates. And so now we find ourselves in this rising interest rate environment. The fear is, as interest rates continue to rise, so does my interest payments on my debt. And so one of the things that we're doing to hedge against that risk is purchasing rate caps. And if you're not familiar with what a rate cap is, think about a rate cap as kind of like an insurance policy, right? You hope you don't need it, but you pay for it just in case you do. And so what a rate cap does is it actually puts a ceiling, at a predefined ceiling, on how high interest rates can go. So let's say, for example, today my SOFR indices is 100 basis points and I buy a 200 basis point rate cap. Then that ensures that if SOFR goes above 3%, I'm not going to have to pay, or my interest rate's going to cap at the SOFR indices of 3%. Okay. And so anything above that, the interest rate cap actually pays us back that overage. And so this is something that is required by lenders, by debt funds and bridge lenders for us to acquire anyway. Or if you're going with a Freddie floater product, for example, any type of variable rate debt, your lenders are going to be requiring you to purchase this rate cap. So it is a good thing. And the thing for us is there's also a variety of rate cap products available. So we can buy a 1 year, 2 year, 3 year rate cap. We can buy 100 basis points, 200 basis points, 250 basis points, etc. And typically, rewinding back to last year, when assuming the purchase of a rate cap, most often most of your operators or borrowers were purchasing the cheapest rate cap because at the time there wasn't a concern for a rising interest rate environment. Fast forward to today, where it's very clear that rates are going to continue to rise, we've now seen those rate cap costs accelerate to an almost unfathomable level. And so we're, the same rate caps where we were paying, maybe just a 5-figure purchase last year are now 7 figures. And it's taking a substantial hit on our acquisitions. And so as a limited partner or as a passive investor in some of these private placements, this is something that's critical for you to be asking your sponsorship team. How are they purchasing their rate cap and what's the motive behind the rate cap purchase? Okay, because you want to make sure that, number one, they're buying a rate cap that suits the business plan and that appropriately hedges against the interest rate risk within the business plan, and that they're not just going for the cheapest option because they are so expensive. And so that's a considerable factor. But the rate cap is one of the very first variables that we're looking at to hedge our position when we look at new acquisitions. And I know for us at Blue Oak, we are willing to pay the more expensive premium to get a tighter rate cap, so that way we can have a better hedge against further interest rate environment. The next thing we're looking at is looking at fixed rate versus floating rate debt. And one of the things that we love about commercial real estate investing or real estate investing as a whole is predictability, right? That's, if you look at the equities markets, if you looked at the crypto markets, you've seen the impact of the downturns in those markets and contractions. We have new corrections going on, and just people have lost 40-50% of the values in their portfolios. Well, we don't really experience quite the volatility or unpredictability in real estate. That's why we love it, right? But what's happening now with the rising interest rate environment and most of the transactional volume being executed on your variable rate debt is you're starting to lose a little bit of that confidence in the predictability. It's creating a little bit of concern, is because we don't know how high rates will go. We don't know when they'll stop increasing rates and such. And so now borrowers are shifting back to fixed rate versus floating rate debt. And typically with fixed rate debt, you can typically get better longer term debt. With that, you're looking at typically agency debt or bank debt, which, with the agencies, most often you have non-recourse debt, long-term 7 to 10 years. You typically get maybe better financing terms on that. But there is something that you should also be aware of when it comes to fixed rate and floating rate debt. When you're looking at fixed rate debt, timing is everything. And so locking in long-term fixed rate debt at a specific time can very drastically different or impact the overall business plan. And take, for example, people that were acquiring acquisitions maybe 2015, 2016 on fixed rate debt, and they were looking to make an exit during the pandemic. They were getting near the end of their business plan, and they wanted to make an exit. Well, because the interest rate market had plummeted and rates were essentially at zero, we saw yield maintenance prepayment penalties increase because of that drop in rates. And we also saw, the cost of capital decreasing to where it made more sense for borrowers to get new fixed rate debt. And so people looking to exit at that time during there were all of a sudden having an exit on loan assumptions with a debt that was not really as attractive, because, when you're paying a 5%, 6% interest, and you can then at the time go get a, fixed rate debt for 2.5%, 3%, it was very hard to sell a loan assumption deal during the pandemic. And so again, the point of that is just the timing. Right now, if you're securing fixed rate debt, you're going to feel really, really good about your position now versus being at the end of the year. But the question you have to ask yourself is, what happens when rates come back down and the interest rates are lower than what your fixed rate debt is today? And I think it's important to highlight that, listen, rates, although it feels like they're always going to the moon right now, they never go up in perpetuity. And actually, it's the reverse. If you look at historical timelines, interest rates actually have steadily declined for the last 100 years, with some volatility, of course, but over the time horizon, interest rates consistently have declined over the years. And so that's a thing that you have to ask yourself getting into a fixed rate debt situation, is the defeasance prepayment penalties that lock you in for 7 to 10 years, and the lack of flexibility when it comes time to exit, just depending on where the market's at. So the next thing that we're looking at right now is looking at lower leverage. And leverage is our holy grail of real estate investing. We all know that, right? We use levered debt to go acquire assets, and that's what makes real estate such a beautiful investment vertical. However, it's also our enemy. And case in point, if you think back to the great financial crisis, how many people, not only investors, but general consumers were over levered, whether that was their personal residence or their investment properties. And when the great financial crisis happened, the entire real estate market collapsed, right? People lost all of their net worth, all of their, substantial liquidity, because they were over levered. And so, the power of leverage is it helps boost our returns, because the more leverage we get, the less capital we have to raise, which ultimately can help boost our returns. So it allows us to get a little bit more aggressive on our purchase price, right? But the thing to be considerate of is, just because you can get max leverage doesn't always mean that it's the best approach. And so we find ourselves in a situation in today's credit market where the credit markets are much more sound, much more incredibly sound. Typically you're looking at deals that are 70 to 80% leverage prior to the turn of the year, which is pretty solid. That means we as borrowers are having to put anywhere from 20 to 30% down to purchase these assets. So the credit markets are in a very strong position. However, if we've acquired deals on variable rate debt at even 75% leverage, and our interest rates are going up, that is going to affect our cash flow because our interest payments are going up. Now we could be in a situation where we're starting to see our debt coverage ratios being tested because of the rapidly rising interest rates and how high they've risen in such a short period of time. And so securing deals on lower leverage right now is a great hedge for this rising interest rate environment. Typically with lower leverage, you have lower risk for both the lender and borrower, which can equate to better terms. And it also kind of gives you stronger elasticity for the deal, better performance against certain stress tests and sensitivities. For example, if your economic vacancy drops to 60%, or your interest rate does go up to as high as 10% in an unrealistic scenario. Things like that, you can weather that storm so much more effectively when you're lower levered. The next thing that we're looking at is longer holding periods. And I think this is such a critical reset of expectations right now, because we've lived in this fantasy land over the last several years when it comes to investing in private placement and commercial real estate, where deals have transacted and, exited in, let's say, 2 to 3 years, but still producing, 5-year performer return projections. And I think what has happened is investors have become to expect that now because of that rapid velocity of returns and exits and such. And so I think what we're experiencing now is a much needed reset back to fundamentals, getting back to more reality. And, you're starting to see that getting back to longer holding periods is going to be required to produce the same returns, those 5-year returns, as we needed to, right? And we're already starting to see a lot of our competitors, a lot of investors opting to sit on the sideline until this interest rate environment kind of cools down. And so, we've all heard the saying, the cliche, don't wait to buy real estate and wait. And I think it's important to reemphasize that real estate is always appreciating in perpetuity. If you look at a time horizon over 20, 30, 40, 50 years, however long you want to go back, real estate is always appreciating in value. Yes, with certain cycles in between, but as long as we buy good real estate and we hold it long term, it's a safe assumption that real estate will always continue to appreciate. And this is how wealth is accumulated in real estate. We have to remember, your wealth is not created through transacting. You can get rich, cash rich, when you're transacting, but that doesn't necessarily build wealth. And so your wealth is really accumulated by buying and holding real estate long term. And again, it's important to note as well that yields have tightened over the last several years, because of the aggressive and accelerated asset valuation and appreciation. We've seen yields shrink and tighten over the last several years. And so, you now take into account the increasing cost of capital, that asset value appreciation, and then the amount of liquidity that's competing in today's marketplace. All of these factors are really squeezing the returns out of commercial real estate. And so if we're going into a rising interest rate environment where our interest payments are being impacted, which is going to impact our cash flow, we're now going to have to hold these deals longer term in order to generate that cash flow needed to hit those projected returns. And so I think it's getting back to, again, those expectations of being prepared for long-term holds, 5 to 7 years. And the last thing I'll kind of sum up this specific topic in is, don't forget, the highly successful investors, the ultra successful investors, they never sell, right? They hold assets for 5, 10 years and longer, and they never sell because they know that, again, that the real wealth in real estate is built over the long term. So this may seem rudimentary, but investing in quality assets is so key right now. As we mentioned a few minutes ago, investors are looking for more risk aversion right now because of the times of uncertainty. And so when you look at the behavior of the market over the last 24 months, there really hasn't been a very strong delta between cap rates and return metrics across the asset classes. And that's been mainly due to the heightened demand for the asset type as a whole. There's been a lot of investment capital coming into commercial real estate, multifamily in particular. And, that has really let the market kind of fuel the overall performance of all asset classes. But when you really dissect the data, when you really look at the data, especially when it comes to the post-pandemic recovery, what you actually find and observe is that the much stronger recovery has been in the A and B class assets versus your C class assets. You've seen the strongest amount of not only absorption, but rent growth in the A and B asset classes versus the C class. And that's really just a byproduct of the demographic, right? When you have a demographic that's earning $80,000 to $100,000 per household per year, that gives you a lot more room as far as potential rent growth versus a family that's only making $30,000, $40,000 a year. And so A and B class assets have outperformed the C class assets over the last several years, especially post-pandemic. And so, that flight to quality assets has been a huge considering factor for groups, especially like us here at Blue Oak Capital. We believe in investing in these quality assets. And so, if you take into account, the variables that are affecting things like the value add strategy. So, things like the labor shortages, the increasing development or construction input costs, supply chain interruptions, all of these things that are impacting a value add strategy that could substantially increase your risk exposure during these uncertain times. And so, we're looking for something that's a little less exposure, have a little bit more control, and less variables that are affecting our overall execution of our business plan. And so I think we're now starting to see that decoupling of A and B assets pulling away from the C-class assets now when it comes to your predictable execution patterns. How much we'll see that, how much of the decoupling we'll have to see. But I definitely think we're getting back to more of seeing that delta now and that spread when it comes to how we acquire C-class versus A and B assets. And of course, with the quality assets, lenders love quality assets. Again, it's a lower risk hedge for them. So you typically can get better financing. And the last point I'll make too, as far as how we're hedging our position, is also investing in quality markets. And this is rudimentary to real estate investing, but investing in the right locations, such as primary markets, is going to be critical for your risk tolerance right now. I think you've seen a pattern of investors entering into secondary and tertiary markets, chasing yield over the past couple of years, and the market has allowed that to be supported. We've still been seeing remarkable returns in secondary and tertiary markets, but the big question mark is, how do those secondary and tertiary markets perform in economic downturns where there's a less dense population, less economic drivers, and smaller markets? And so your exposure there could be much higher, just depending on that type of market. So we particularly believe that investing in dense primary markets that are constantly attracting new businesses, new jobs, new net immigration, population, things like that, are key to really hedging our position right now. And we really believe in the strength of being invested in a primary market. So, Brian, I guess the big question in summing all that up is, should investors be investing right now?
I think so. And we're going to give them a few reasons why we think investors should still be investing in commercial real estate today. And on the next slide, the first thing I want to show everyone is this chart. This is the Investor Sentiment Index. And this was put together by wealthmanagement.com and Marcus and Millichap. And it shows what are the current sophisticated, high net worth, ultra wealthy, the REITs, the institutional funds, are they still bullish on commercial real estate? Do they still want to invest in commercial real estate? And if you look at the very end of the chart, you'll see that they are. In the first half of 2022, the Investor Sentiment Index actually rose 5 basis points from 165 to 170 basis points. So I want to spend the rest of this presentation for the next couple minutes just talking about the strong fundamentals and drive into what's fueling the Investor Sentiment Index. On this slide, you'll see the first thing we're going to talk about is the strong credit market. Cody kind of alluded to this earlier, but the credit market is still very strong. A lot of people have asked us personally about real estate crashes. Are we going to see what happened in 2007 and 2008? And our answer to that is we do not believe so, because of all the reasons Cody has already mentioned. Lenders are hedging their risk. They're not exposing themselves to the same risk that they were doing back then. They're not giving out the ninja loans, which we've probably all heard of, the no income, no job, no assets, to people that aren't qualified buyers, both for the residential real estate and commercial real estate. We're seeing lower leverage, right? So we talked about the 55 to 60% leverage that we're seeing in agency debt. So the credit market is still very, very strong. We also are still seeing a lot of liquidity and a lot of demand for commercial real estate. Over the last several weeks, we've seen what has happened in the equities market. We have seen what has happened in the crypto market. So there's still a lot of liquidity and demand chasing commercial real estate, not only chasing yield, the cash flow, but they're looking for that hedge against inflation. They're looking for that place to shelter and protect the wealth that they've built. So we're seeing that incredible demand. And the last point I'll make is that we are becoming a nation of renters. Some of us by choice, the younger generation that really love living in the B+, A- assets that we are looking at over at Blue Oak Capital, but also due to a rising cost in housing and the affordability gap, which we'll talk about on the next slide. So we are still short several million homes in America, which I think we've all seen the headlines. Depending on where you pull your data, we're anywhere from 3.5 to 5 million homes short. And this was actually a growing problem before COVID. Everybody thinks that, COVID caused the housing shortage, but that's actually not the case. Freddie Mac estimated in 2018 that we were short 2.5 million homes in 2018. So the COVID pandemic, all it did was accelerate what was already happened. It made that number grow. We went from 2.5 million homes being short 2.5 million homes to now being short anywhere from 3 to 5 million homes, depending on who you look at. And the current labor and materials market is making this problem worse, right? So we're seeing this all the time, how much the material cost is, labor cost is extremely high. And this is just one of the variables that has caused home prices to rapidly rise over the years. So many first-time home buyers just cannot afford to buy a home anymore. They're in their mid-20s, they're in their early 30s. They want to buy that starter home, so to speak. There's a lot of data and a lot of charts just showing that there's a massive affordability gap between what you can rent at that life stage and what you can actually buy right now. And on the next slide, we'll talk about that a little bit more detailed. Why are we renters by necessity? First of all, as you see on here, there's been a massive increase in the median home price in America. The slide shows $400K, but the actual number is actually closer to $428,000. So the median home price of homes in America in Q1 of 2022 was over $428,000. So this, along with rising interest rates, has just priced out a lot of buyers, and it's led to the biggest drop in home sales in 9 years in April of this year. So if you go and search new home sales, you'll see that April 2022 had a 16% drop in new home sales compared to the month before. And this is a big reason why. It's because buyers can't afford to buy with the rising prices, and now we have rising interest rates. So the gap between renting and buying has just drastically increased. Just for a quick example, I like to use Houston as an example because we're here in Houston. We're Houston based. The average home price in Houston in 2022 is around $375,000. So if you put 20% down and you assume a 5% interest rate, depending on your HOA and different fees involved, your mortgage payment is between $2,800 and $2,900 a month, and that's with a 20% down payment. Not everybody has $75,000 or $80,000 to bring to the closing table for an average home. So you're paying $2,800 to $2,900, when the average rent in Houston today is around $1,300. So you have that massive gap between the cost of renting and the cost of buying a home right now. So that's really, really, causing that renter by necessity. And we are also seeing a lowest inventory on record, which I think we all know. If anybody has tried to buy a home, whether for an investment property or just for your primary resident, there just has not been enough homes on the market. We're starting to see some improvement, but at the end of the day, there's still not enough homes, affordable homes on the market for those first-time home buyers or for those middle-class Americans. The other reason that we are still very bullish on investing in commercial real estate is it's a hedge against inflation, right? Rents are outpacing inflation, and that is good news for us. Houston saw north of 16% rent growth in 2021. Houston's one of our primary markets, and we're seeing double-digit rent growth again in 2022. The other reason we're also very bullish is in assets like multifamily, for example, which we love. We have the luxury of short-term leases compared to other asset classes, say like retail or triple net or office, where you're signing 3-5 year leases, sometimes longer. We have the ability as multifamily landlords to raise rents every 12 months, every 13 months, depending on the lease term. So if we're seeing wage growth, if we're seeing inflation, we're going to be right behind that. We're going to be able to push those rents even further to have that great hedge against inflation. And the last thing is inflation eats away at today's levered debt. That's one of the big reasons that we love, using responsible amounts of leverage. Inflation beats commercial real estate owners because it eats away at today's levered debt. So just great reasons to invest in commercial real estate. It's a great hedge against inflation. We're becoming a country of renters by necessity versus choice, and we just have massive housing shortage. So on this last slide, I just want to, kind of wrap this thing up. And if you want to invest like the high net worth and the sophisticated investors do that we were just talking about, then we want to offer everybody the opportunity to download this free guide on why you should be investing in places like Texas. Steve started this presentation by talking about one of the benefits of using your self-directed IRA to invest in private placements is you get to help impact your local community. So if you're here, you're Houston based or you're Texas based, and you want to see your community get better, you want to see, just an improvement in life from tenants in other commercial real estate, we want to partner with you. We want to show you how you can put your dollars to work and help benefit the community, help invest in Texas. So download this free guide. It's going to give you some great reasons on why we're really bullish on Texas, why we love Texas, why we want to put our time, our energy, our dollars, and our efforts into Texas. And with that, I'll wrap it up and turn it over to Steve back. And Cody, anything else?
No, great job. Steve, I don't think we can hear you.
Are we there?
There you go.
Okay. Yeah, that was great stuff, guys. A lot of good insight. Appreciate the localized comments too. And again, just that improvement, that local improvement, I think is definitely, in my view, I think that's one of the key differences between, regular IRA and a self-directed IRA is that localized impact that you can see. And it's true, whether you're doing a fix and flip, whether it's a syndication deal, or even if it's lending, because, in a case like that, you're putting money in someone's hands who's doing the same thing. So I think, any way you look at it, you are making that impact by way of your self-directed IRA. Couple of questions, a little quiet in the box today. There was a question about the deck that you were showing. Now, of course, we will be archiving this presentation, but, again, is it okay for people to reach out to you guys directly if they want to talk further?
Oh, absolutely. Please do. Yeah, absolutely. Yeah, you could connect with us directly at Cody or Brian at blueoakinvest.com. Shoot us an email. We'd be happy to reach back out to you and schedule some time to connect.
Yeah, you can also connect with us through our website, which is blueoakinvest with an S at the end.com.
Right. Okay. Not investments, as I learned. Let's see. Questions about the September event. I think that has to do with tickets. So again, questexpo.com. Let's see. Well, it seems like actually, I think you must have hit all the points. Any other things you might just add, or we are coming up on the top of the hour. We certainly can break a little early, but what are some of the final thoughts that you guys have, or maybe what are some of the questions you're hearing from other investors?
Well, I think the big question right now, again, which is the thesis behind this presentation today, is, hey, what are we going to do about this rising interest rate environment? How are we protecting ourselves against that? And so, we've kind of explained some of those strategies now. I think the other question that we're seeing or observing a little bit is people are feeling a little uncertain. People are just a little bit concerned with the lack of predictability in the market right now, and whether they should continue to invest in today's environment or should they continue to wait. And, my position on that and my feedback to you is, listen, now is still a great time to invest in commercial real estate. It is an absolute perfect time to invest in private placement and real estate. But it's just like any other market cycle. You just have to really understand the levers that are going on and what's impacting today's climate, and just adjust your expectations to that climate. And, I would encourage people to really just pay attention to, the behaviors in the marketplace. How are investors, especially how are the more sophisticated groups, how are they acquiring deals? What type of deals are they acquiring? And really pay attention to that, because I think that'll help guide some of your investment decisions. I don't know, Brian, you have anything to add?
No. I mean, a lot of people, especially self-directed IRA people, that's it's one of the things that you have to be considered. Like when you have a self-directed IRA, you have to make decisions, right? That's sort of the hard part about a self-directed IRA. And standing on the sidelines is a decision some people make for a long period of time. They try to time the market, but Cody alluded to this earlier. That's not timing the market, it's time in the market. So as long as you have the right sentiment towards your investment choices, whether it's multifamily, triple net, industrial, fix and flip, crypto, whatever it may be, you have to have your expectations in check and realize that these alternative assets, these non-liquid assets, they're not as volatile as the things you're going to experience in the equities market, but they're also slower pace returns. They're something that you have to invest in for 5, 7, 10 years. They're really about building wealth, not about the quick fix and flip where you get your return back. But I think you just have to have the right time outlook. And if you have the right time outlook, you have the right sentiment, you understand what's going on in the market, it's really going to give you a lot of confidence. Stay educated, stay on top of what's actually going on with the data. Don't always follow the headlines, because the headlines can be very misleading in real estate. You're going to see you'll see 2 headlines and they basically say the opposite thing. So you're like, okay, well, is it going good or is it going bad? So you can't always follow the headlines. You have to read the data. Look back at history. It's going to really show you what has happened in the past. History tends to repeat itself. And then figure out, what is my investing sentiment right now? What type of assets do I want to invest in? And then you need to go out there and take action and make a decision.
Yeah, Steve, you highlighted this as we were getting into the presentation. There's over $400 million in your customer and your client liquidity that's just sitting there. And if your capital is just sitting there, obviously, we all know this, right? It's losing value. And so it's very important that you go and start moving it into these real assets. That way you can fight against this inflation. If it's just sitting there, it's just dead money. So get it moving.
Definitely. Let me ask you guys, just as we wrap up here in just a few minutes here, your opinion. Let's use the Quest office locations: Houston, Dallas, Austin, and Austin, San Antonio. What strengths, weaknesses, or just general opinions where you guys seem mostly concentrated in Houston, but what are some of the characteristics of the different markets, do you think?
Yeah, I think Central Texas as a whole has been performing extremely well. When you look at all the 4 major metro areas, all of them have been outperforming quite well over the past couple of years. I mean, Dallas has always been kind of the quote unquote golden child of Texas, if you will. It's always performed probably the strongest out of all the metros. Austin has seen the probably strongest amount of growth over the past couple of years, and that's been no secret. But I think what that's done is, because those markets, Dallas and Austin, have been such a hot target area, you're now seeing a lot of opportunity in areas like Houston and San Antonio, where the demographics and fundamentals are still very strong, and there's still a lot of investment opportunity here. And so I think you've seen a lot more investment capital coming into Houston and San Antonio because of the hyper competitiveness and oversaturation in markets like Houston, Dallas, and Austin. So I think with either one, obviously each market's a little bit different, but I think there's a lot of opportunity across any of those MSAs, in particular Houston, San Antonio right now.
Nice. And let me just ask one other question. With the investors that you use, I get asked this question a lot, and I hear various answers. Do you guys have buy-in minimums or investment amounts that you look for with new investors?
We do. It's very deal specific, but your industry standard's about 50 to 100,000.
Okay.
And that's pretty consistent across the entire industry.
Yeah, that's what I would say.
Yeah, but it's very deal specific and very operator specific as well, just depending on the dynamics of that particular deal. So, but that's what you can generally expect.
Okay. Yeah, very consistent, and those seem to be real reasonable amounts, especially relative to the amounts that we tend to see with our investors. So Great. All right. Well, why don't we adjourn there? We've got 2 minutes until the top of the hour. This has been a great presentation. Time well spent. It does look, we're getting some great comments about you guys, and some people may be reaching out to you as part of their next step in their investment process, which is always what we want and always what we hope for. So that being the case, I want to wish everybody a happy Saturday, a great weekend, and we will see you next time at one of our webinars or our events live, or hopefully whatever the case may be. All right, guys, thanks so much.